Good afternoon? Oh, very sleepy from lunch, right? Yeah, so I asked them why give me this slot. This slot is the toughest. But today I'm really going to bring you guys a lot of value. Just a slight correction to what Sean was mentioning, no fault of his. I'm actually not an analyst with Value Investing College. I'm an independent person. I do my own investment, but I was a student from Value Investing College. I'll go through a little bit about myself before I jump into value investing and what options stands for. But meanwhile, while people are still streaming in, those who are here, just to make sure that you all are staying awake for the rest of the presentation, can you just turn to the friend next to you and give them a high five and say, stay awake? Okay? Because today, this program, while it's free, is full of value. All right? And who has attended the morning session? Who was here in the morning? Can I have a show of hands? Yeah, I think about half of you. You guys are way early to attend the first half. I was here in the front listening to CMC, DBS, and Mr. Ron K as well. And I don't know about you guys, but I was really confused. Okay? When, how many of you all actually understood what the lady from DBS was saying? Hey, nobody understood. Why you never tell her? Then she went back already. Okay, never mind. How about also another lady from CMC? Anybody understood what she was saying? Hey, you also don't understand what she was saying? Okay, so later, right, whatever I say, if it's not very clear to you, if there's time, I'll be more than happy to answer your questions. But really, if you have doubt, like what just now they show in the clip before I came out, really is to ask. Every investment you must ask, then you must check, and then you must confirm, right, Sean? Okay, so that's their strategy, ask, check, and confirm. Okay, now, for myself, I'm an independent value investor. I also use options as a strategy to increase my return. And together with VIC, last year, we co-authored a book. Unfortunately, today I can't bring this book here because it was sold out. Okay, we are currently going through the second print. However, there's a booth outside by VIC, the good staff of VIC. So if you guys would like to understand more about VIC, you can approach them. Okay, I started learning investing in 2007. And it was really tough because I was reading just books. Being a nerdy person, I thought the books will allow me to understand what investing is. But on hindsight, it was pretty stupid. It is like sending your kids to tuition and just giving them textbook without going through school, and you expect them to pass the exams. Do you think you will pass the exams? Anybody think you will pass the exams? Hey, very good, very good. I see a few confident people, but the rest of us, we are human, right? So we need to attend schools. And this is where I feel very strongly for Singaporean because we are one of the largest saver. Like just now what one of the ladies mentioned about Singapore being a very huge saver. We save a lot of money. But in terms of investment rate, we are by far one of the smallest in investment in developed countries. Okay? Now, a bit more about myself. I attended Value Investing College in 2012. That's where I come across value investing. And I'm happy to say that currently I'm managing my own family's portfolio, right? Okay? Yeah, anyway, this guy is Sean. He's the founder of VIC, and that's where I got to know value investing through him. Okay, disclaimer, a lot of words just to cover my ass. But basically, whatever I share here is purely for education purpose. But if you choose to take action, and you were to get some returns and profit from it, whose credit is it? It's your credit. Everyone say, it's my credit. Okay, try again. 1, 2, 3. It's my credit. Yeah, okay, it's your credit. If you take action, it's your credit. But if you choose to take action and you lose money, whose credit is it? My credit. Okay, it's also your credit. But I just want to make it clear that this is really for education, and I really want to share freely so that this will allow me to share freely. Okay? So really don't just anyhow go and buy and sell. Really do your own research. Okay, to start off, back to what I mentioned earlier about just now in the morning, there were a few sessions about how the market is going to go, Trump, and yada. So I presume most of you all here have a mind of your own about where the market is going to go, right? Okay? I'll just ask a very simple question. Over here, who thinks that going forward, the market is going to continue to rise? Have a show of hands. Okay, good, good, okay. Who thinks that the market is going to come down going forward? Show of hands. Who, no matter what I say, won't raise your hand? Okay, so you can see within this hall of 400-500 of us, there are very differing views. Some of you all feel that the market will go up. Some of you feel the market will go down, sideways, left, right. Okay, that never goes left, right? You always go right side only. But really, it is a black box. It's a game of probability. It's a game of chances. Okay? I'm going to share something that is a bit in contrary to what was shared in the morning about the market. And I respectfully do not agree with some of what the speaker has mentioned, especially about the market. And I will explain to you why, and I will leave it to you to make your own judgment. Okay? Now, before I go into this sharing, I just want to explain to you what does the market do and what are the terms. Okay, bull market is very simple. Bull market means go up, right? But we need to understand the bear market, okay, coming down. Now, there are a few facts about the stock market that is coming down. Okay, the first word that you need to learn is correction. Okay, anyone here know what does correction mean? Drop by how many percent? Anybody? Hey, I promise you got prize one. Raise your hand, raise your hand. Raise your hand, run to the mic. Anybody? 33%, wow, that one died already. Something wrong already. Raise your hand and run to the mic. I'll give you a present later. Raise your hand and run to the mic. Anybody? Or nobody want to? I don't understand. The instruction quite clear, right? Raise your hand, run to the mic. Okay, gentlemen over here.
5%?
5%. Very close. Very close. Anybody? 8% is very close. But you didn't go to the mic. It's okay. Yes. 10 to 15%. 10 to 15%. Okay, okay. I think it's quite close. I'll remember you, gentlemen. Okay? So, a correction basically, right, is when the market drops more than 10%. 10% onwards, people will start saying, oh, it's a market correction, it's a pullback, yada, yada. Okay, but the key thing is, correction will always recover, and generally it recovers within less than 2 months. Okay, it will recover generally, statistically speaking, about less than 2 months. Now, if the correction were to go down some more, what will it turn into? Yes, it will turn into a bear market. Okay? So a bear market, now another gift to give out, how many percent and above that is called a bear market? 70%. Wow, 2008 crisis times 3. Anybody? Hey, really, I just want to be fair so that it's fair to those who answer. Maybe just run to the mic and answer. It's very fast. Really, really. And especially you are sitting next to the mic, so very, very quickly, just run to the mic and say. Yes,
20%.
Take action and you will get rewarded.
20%.
Yes. Sorry? 20%. 20%. Awesome. Okay? He's absolutely correct. By definition, if the market fell below for more than 20%, okay, technically, you will see the analysts start to shout that it's a bear market. Okay? And how long does the bear market take to recover? It's much longer. Okay? Generally about a year or so. Okay? So these two are the key definitions about a market that's trending downwards. It's either a correction, and if it goes a lot further, it becomes a bear market. Now, the statistics that I want to share is very important over here. Okay? If you want, you can take a picture of these slides. Okay? Sorry, I won't block you, but you can take with my handsome face. Okay? Statistics. Correction tends to happen once a year. Going backward, when we look at history, once a year you will see a correction. Okay, this year's one has not happened yet, but if you look at last year, it happened once. Even when you look at China, Black China crisis 2013, it also happened once. By the way, that was not a bull market, that was just a correction. It only went down by about 17%. Okay? Now, whereas bear market happens about 3 to 5 years. Every 3 to 5 years, there will be a bear market, generally speaking. Okay? And about 20% of this correction will usually develop into a bear market. That's the third statistics that I want to share with you guys. All right? Finally, every bear market will turn into a bull market. The last point seems to be common sense, right? Then everybody's like, But a lot of people, while understanding it intellectually, they do not believe it because they don't act upon it. When a bear market happens, where is all the investors? Do they run in or run out of the market? Run out of the market. If they believe that the bear will turn into a bull, what should they be doing? Run in. Exactly. Okay? So, maybe just hazard a guess, just looking at US market, Singapore market, where do you think we are now? Are we overvalued, undervalued, going through a correction, or going through a bear market already? Anybody? I think this morning they gave you all quite good understanding about the current market. That's one thing that I agree with them. Anyone? Yes? We're undergoing correction. Interesting. Anyone else? Sideways? Anyone else? Still sideways. Okay, if you look at the PE ratio, okay, of S&P 500, this morning there was a very similar slide shown, but I just want to show you going back into history, 1930s, over here. This is the PE ratio, price to earning, basically what is the market price at versus the earnings of all the companies in the S&P 500. And you can see there are gray out areas. Those were the crisis areas. For example, in 2000, 2001, there was a dot-com bubble. In 2008, where there's a super spike, that's the financial crisis, the global financial crisis. Okay, so on average, do you know the PE of S&P 500? Anybody? Nobody want to guess already. It's about 16. Okay? So now, we are in slightly higher territory. We are about 25. We are about 25. Okay? This is where I disagree with the morning speaker respectfully. Both of them say that there are rules for the equity market to run. Of course, there is always room. On the chart, there's always room. In fact, you can run as high as 2008, going to P of 100. But statistically speaking, if you look at the chart, whenever it's going above touching 20, going above 20, very soon after you will see the market coming down in terms of PE. Okay? So I'm not saying that the market will go down tomorrow or the year after, but I'm saying the chances of it happening is much higher now than when the PE was a lot lower. Okay? Now, looking at Singapore, what do you think is the average price to earning ratio for Singapore? Anybody? Singapore you all should be more familiar with. Anyone? 30, Sorry? 12 to 13. Anybody else? 16. Final price? No, I'm joking. Anybody else? 17? Okay? Depending on which year you cut off, okay, is about 17. Okay? It's about 17. The current PE ratio is in the range of 13. So you can look at it in contrast with the US. US, we look at valuation, we are likely to be overvalued now by definition. But in Singapore, we look like we are undervalued. But do not forget, which market affects the Singapore market the most? US. So even if we are in the 13 PE now, we are lower than our past average. Anyway, this average is a 30-year average. If the US were to go down, the US market, Dow Jones, S&P were to go down, do you think Singapore can still go up? Anybody? Okay, the chances are we will be affected. We will be dragged down together also. Okay? Which is why I really like this photo. Anybody watch Game of Thrones? Know what I'm showing here? I want to give present also. Okay, no, I'm joking. Okay, Mrs. Yellen has raised interest rate 3 times in the last 4-5 months. Okay? However, it is interesting because we know that the market is also very high. And we know that usually when the interest rate is rising, the asset prices, the market tends to go in the reverse. Okay, so we know the winter is coming, but the question is, when? When is it coming? Tomorrow? Next year? So on and so forth. However, while we don't know that the market, whether it's going to crash tomorrow or not, it is still important to protect your downside. Okay? You need to protect your downside, no matter the market. There's this saying, take care of your downside, and your upside will take care of itself. Okay? So now the situation that I will use an analogy to describe is we are at a mountain, and it's snowing. And there's a lot of snow piling up. And those who have gone skiing, you know there's such a danger called an avalanche. But by looking at the mountain like that, do you know when the avalanche is going to come? You will never know. You will see the snow keep piling and piling and piling, which is like the market going upper and upper and upper and upper. But you never know when it's going to come down. But when it comes down, you don't want to be like the guy in the circle. Okay? You don't want to be caught with your pants down, literally. Okay? Which is why in this current market, okay, it is very important, and I stress, this is my own opinion, it is very important that you don't be a speculator, because you cannot out-speculate the market. I'll just put it out there. Many people will disagree with me, but I believe you cannot out-speculate the market. Okay? This is why you need to learn value investing. If you learn value investing and you are ready, later I'll explain why this is perhaps one of the best opportunities for value investors ever since 2008. All right? So when a bear market comes, will you be running away like this little girl? Or will you be like a Black Friday sale running into the shop? Okay? If you are a value investor, you should be running into the shop. Okay? Now, let me share a bit about what I was doing previously before I learned value investing, and see if it resonates with some of what you are doing now, and how I turned to value investing. I said that I started in 2007, around where the circle is, and in 2008, the market just went higher and higher. I thought I was the market genius. The moment I started investing, the market went my way. I bought, the market go up. I bought more, the market went even higher. I really thought I was genius. But lo and behold, I thought I huat already. Okay? But lo and behold, really, the market starts to come down. And it's very fast. It's like an avalanche. All this happened within 6 months, the first dip down. You will be caught with your pants down because you are still trying to think, hey, will the market recover or not? Should I cut loss now or not? Okay? So in this situation is when you speculate. You think the market is going to go up further, you want to catch the momentum, and you want to go higher. But the next thing you know, the market starts to come down faster than you can react. Just now there was some talk about what automatic guaranteed stop loss, right? I don't know. I don't know. I really don't know. Okay? You can try. But when China had their circuit breaker kick off, nothing was guaranteed. Okay? Now, first thing, before we even talk about value investing, I just want to show you or understand what is value investing. Okay? Now, a lot of people talk about charting. You know, just now I was at Coffee Bean, and then I heard some people talking about, wow, technical, charting, sideways, and even different kind of strategies. I heard this strange term called iron condor. I don't know what is it. Okay? Then there's technicals, there's momentum investing, right? And of course, there's news investing. This is the latest one. Buy on the news. When Trump tweets out one letter, you go and bet. Okay? And of course, there's value investing. And I was exploring all this in 2007. I don't know which one is the best. I wanted to try them all. Okay? And I tried in this order. Right? I only come to know value investing last. Okay? But how I come to value investing is after I lost so much in 2008, then I wanted to know, hey, who is the best out there that I can learn from? So does anybody know who is the best investor in the world? Yes, Warren Buffett. Okay? He outbid almost any other investor by miles. And I wanted to learn how does he do it. Okay? This is Berkshire Hathaway. versus S&P 500, he beats the market flat consistently for decades. Okay? This is what prompted me to look more into value investing. There must be something here. Now, then I wanted to learn from Warren Buffett. Then I saw this news. I got depressed. I thought, hey, maybe I go and pay a few thousand, can attend his course. Then I realized, hey, he doesn't attend courses. But maybe I can go to the Berkshire Hathaway AGM and meet him. Then I realized, wow, to have a lunch with him is 3.46 million. And this time, he just put out his lunch for auction again. And I don't know how much it's going to be bid for, but anything in the millions, I think I'm out of reach already. Okay, so how to learn value investing for Warren Buffett? The way I did it, okay, was to look for Sean. He's a good friend of mine. I knew he was doing value investing, but I didn't quite know where he got it from, right? And I asked him, hey, can I learn it from you? Maybe I cannot learn from Warren Buffett, I learn from a Singapore one first. Then eventually I go US, right? Okay, coincidentally, he knew this lady, Mary Buffett, okay? She was the daughter-in-law of Warren Buffett, and I say was because she's no longer, but she kept the name anyway. So she was actually conducting a course based on the philosophy and methods of Warren Buffett. And Sean was collaborating with her to conduct the course. So I decided to plunge in and go ahead and learn from her. So that's Mary, although look quite different, but she's still very good. Okay? So I wanted to know what was the secret sauce of Buffett. And Mary just showed me this slide. She told me this is the secret sauce. It is very simple. You have the red line that tells you the true value or intrinsic value of something, in this case a stock, and you just let the stock market run up and down like a crazy fellow, and whenever the stock price goes below the intrinsic value, you just buy. Then I look at it and say, really? Like that only? I pay a few $1,000s and it's just like that only. And she said, yup, that's it. And we went on and tried. And really, lo and behold, it works. It really works. Okay? How many of y'all here are value investors? Value investors are usually very shy on because they're very humble, and they don't really want to go and brag to people that I'm a value investor. But really, in this market, if you're a value investor, stand up and start jumping already. Okay? For the rest of you, if you're doing trading, technical, charting, momentum, that's fine, but I really encourage you to look into value investing. Okay, I'll show you some examples. Okay, Singapore example. Anyone know this company? SI2I? Don't know, right? It's one of those small, quiet company that people don't really know. But that is where value will present itself. Because if everybody is trading a particular stock, generally the stock is quite well priced on. But if very few people are buying and trading that stock, there's a chance that there might be a sale, a good discount. Okay, I love my wife's analogy. She loves to buy branded bags. I try to stop her. She will tell me, if I go to a very ulu shop that sell this same branded bag, likely I'll get a discount. Then I ask her why. Oh, because the people there are so few, they don't know the true value of the bag, they anyhow sell. This is exactly the same as value investing with small cap stocks. Okay, so SI2I basically, you can go and read up, they do many things, but now they're going into electric cars, right? I value it at about 170. I saw it at 150. At that point of time, I don't know options, I don't know charts, I just bought it at 150. And I just let it ride. And really being a value investor is a lot about mindset. Do you see that it dropped to 120 and below during July? If you are not a value investor and you don't know what you are doing, you don't know the intrinsic value, in this case, I price it at about 170, you'll be very scared. Because you already lost more than 10% of your capital already. Okay, but I hold on to it because I knew that my valuation was sound, and I believe in the intrinsic value eventually. And by November, it was 175. I sold half my position. And if you were to check SI2I now, anybody can tell me how much is SI2I now? Sorry? $2. Okay? Next example, SP Corporations. When it went on to the news to talk about there was a turnaround company, they are seeing profits for the first time in a few years. On Business Times, there was no analyst reaction. Nobody wanted to talk about this company. Okay? But I look at it, the intrinsic value was good, about 90 cents. It was selling at 48 cents. This is what I call fire sale. Okay? So when I talk to my family members, I say, hey, got this company, should we use our family fund to invest? One of my cousins tell me, MTL. You know what's MTL? 卖涂料. We go ahead and get it, and we are still holding it now. Even though it's at about 70 plus cents, we are still holding it now. Okay? And we have strong belief because we calculated the intrinsic value. It's 90 cents. And we recalculate it every quarterly. Okay? One more, DoTech Holdings. This one is one of those strange ones. When you tell people, hey, buy into China company, straight away they go, huh? China company, can buy or not? Don't know the numbers can be trusted or not. They tell you they have business, but actually back in China got nothing on. Okay? So this one we did extensive research and we look at the intrinsic value. The intrinsic value actually goes beyond the chart. We calculated the intrinsic value about 80 plus cents. Can't remember the exact number, 80 plus. Bought it at 40 cents, close to a 50% discount. It was great. We just hold on to it. Every 3 months, we recalculate the intrinsic value, and that's it. We left it as it is. And currently, it is still doing very well for us. Okay, so these are local examples that I have for value investing. Okay, can you use this in other countries? Definitely. Okay, personally, I use it in US and in Japan as well. These are my 3 main markets. Okay. So now, knowing value investing, if the bear market comes, say you wanted to buy, just now was mentioned what, MM2, right? If MM2 dropped by 50%, and you knew MM2 was worth a certain amount, that's the bear market, right? Will you run away from the bear, or will you run into the market? How many of you here now, after what I've said, likely will run into the market? Wow, thank you for the 2 supporters. Hey, the rest of you are still not convinced, right? So when you all see the bear, you all literally run. Hey, but actually in real life, if you see a bear, please don't run also. The bear will murder you. Okay, but in the stock market, really, actually this is one of the main things that I agree with the previous speakers, is they say in a very technical term, they say basically if there's a sell-off, we view this as an opportunity to buy. Wow, quite cheap. Basically, my point is, if the price goes below your intrinsic value, you can go in and buy. Very simple. Okay? The key thing is you must be able to hold the position. You don't buy, then after that, the price drop by 10%, you start to shake away. Then drop by 5 more percent, you start to sell. Then you are not a value investor. Okay? So now looking at this, personally, I'm really hoping the bear market will come. I'm holding so much cash now that I'm ready to run into the shopping mall. Okay? It sounds like a bad thing to say, but that's what I'm hoping for. Right? But earlier on I mentioned, you need to cover your downside. And this is one of the main things that I want to cover today, which is options. How many of you here have traded options before? 1, 2, okay. How many of you here have not heard of options before? Okay. So for the rest of you, I think you are not sure. Okay, let me run through what options is. And let me explain to you how can it protect your downside. Okay, Sean, how much time do I have? 12 minutes? Okay, I'll go really fast. Okay, there are 2 types of options, call options and put options. Call just means you have the right to buy, and you have the right to sell. Today, we'll just touch on call options. Here is HDB Hub, right? How many of you here bought a HDB before? Suddenly got more hands, you all got more affinity with your HDB, right? If you all have bought HDB before, you all would have done this thing called the OTP. What does it stand for? Options to purchase. It is the exact same thing in the options market, in the stock market. Okay? So when you buy the options, you are literally buying the right to buy something, to purchase something, okay? Now, use an analogy. I like this business, this company, and say the stock price is $10,000. A bit high, but let's just say $10,000. I really like it very much, but I don't want to buy it outright. I want to use options to buy the stock. So I want to buy it from someone, right? So it has to be somebody, okay? So Pete will buy from Bean, and I'll tell Mr. Bean, hey, I would like to buy this stock from you for $10,000 and maybe 1 year from now. Basically, what I'm telling him is, from now till 1 year later, during this 1 year period, if I want to buy this stock at $10,000, he will have to sell it to me. I'm making him promise me, basically. Okay? Now, if I want to have this option, in HDB, if you buy a OTP, how much must you pay? How much must you pay? $1,000 for HDB. Has it raised to 2,000? I can't remember. But last time it was $1,000. Okay? So similarly, over here, I need to buy the option. I need to buy his guarantee to me. So what I'll do is I'll exchange money with him and he give me the contract. Okay? I buy his promise that he will sell me this stock for $10,000. I give him $1,000 as the promise cost, the cost of the promise. Okay? So going forward in the next 1 year, there can be 3 outcomes. The first outcome is if the stock price dropped to $1,000. The second outcome is nothing happened. The stock remains at $10,000. And lastly is if the stock goes up to 16,000. I'm just using an arbitrary figure. It can go up to 1 million for all I care. Okay? So there's only 3 ways, up, down, or going sideways. Now let's look at what is going to happen when you own the option. If in the first scenario, the stock price plunged to $1,000, how much do I lose? I lose 1,000 only, because I bought his promise to sell me the stock. But do I have to buy it? Must I buy it? The answer is no. You have the option. That's why it's called option. So all I will lose is the cost of the option, which is $1,000. Of course, if it's maintaining at 10K, everything neutral, I don't lose, don't win. But if it goes up to 16,000, this time my profit is how much? 6,000. Okay, so my initial capital is only 1K. What is my ROI? My ROI is 600%. Okay? Now you look at what if you bought the stock outright at the very beginning. This is the difference. If I bought the stock outright at 10,000, now it's worth 1,000, how much did I lose? I lose 9,000. I lose 90% of my capital straight away. Okay? You will see that for the other 2 scenarios, I am the same as option. I do not do better, but neither do I do worse. So net, if you bought the stock outright, your capital is $10,000. And even if you win, the stock price goes up by $6,000. What's your ROI? 60%. Okay? So do you see the power of options here? Okay? So let me summarize the power of options for you. The benefits. You have a much lesser downside. If the stock goes against you, all you need to lose, all you can lose, is the price of the option. But you have the same upside as the stock. The stock can go up by 10,000, 20,000, you will have the same upside. You will profit the same. Okay? You can start with a much lesser capital. I think this is key. A lot of people who come to learn value investing and options, one of their main concern is, I do not have enough capital. I start with a very small capital. If you start with $2,000, you buy Singapore shares, I think you buy 2 companies, that's it. Or even 1 company. Okay, but with options, you can start with a much lesser capital. And the key thing is, Warren Buffett does it too. Okay, not many people knew about this, but Warren Buffett always used options to improve his return. This is the newspaper article. It says that Berkshire Hathaway profits 49% more based on what Warren Buffett did with derivative. Derivative is a very technical term. What they're referring to is options, basically. Okay? Let me give you an example for US. Anyway, I want to highlight, in Singapore, can you do options? Singapore has this thing called warrant, but it is not exactly the same as options. So by and large, Singapore, you cannot really do options. But you can do it for US, you can do it for Hong Kong. Okay? And that's what they teach at Value Investing College on how to use options to improve our returns. Okay? Back to the example very quickly. AAPL, what company is this? Apple. Okay? Everybody loves Apple. All the iPhone users. Okay? Now, I value Apple at $105. Okay? During November. Sorry, is it November? No, May last year. Okay, so I bought the options to say, from May to November, I want to have the chance to buy Apple at $105. And the cost of my option, okay, they call it the premium, is $1.95. Come November, Apple price went up. Remember the third scenario of the stock just now? So it's the same. Apple price went up to about 110. So now this option is worth $5.50 because it is going to expire very, very soon. It literally means I have the right to buy Apple at 105. The next thing I can do is I can sell Apple at 110 to the market, which is why the premium of the options is now $5. Okay? So in this case, what is my max loss? Maximum I will lose. 195. Okay? That's all I will lose. If I got it wrong, if Apple went down, I will lose 195. But if I buy Apple outright, 195. Sorry, 105. I will lose 105 potentially. And your outlay of capital is $105. Okay? So my max loss was really 195. But my max profit, I'm not sure. Apple can go up further. And after this trade, I continue to do options on Apple. Okay, so can you see the beauty of options? It is a very safe way of investing in the stock without committing all your capital. And yet, you can leverage on it. Leverage is a bad word, but you can tap on it to gain the same upside as a stock. In this case, we are not leveraged, because leverage just means if the stock goes down 10%, I lose more than 10%. It's not true. In this case, however much the stock goes down, I will not lose beyond my max loss, the cost of the option. That's it. Okay? Now, back to this chart. So I hope now, looking at this, knowing what the market likely may be going forward, the chances of it going down, knowing what value investing stands for, and how you can use options. Okay? This is a very fast crash course. I don't think it does any justice to you guys. But I only have 45 minutes with 3 minutes left. Okay? So, I just want to end out with this quote. Volatility is the friend of a value investor. It's really a friend. Okay? And I hope you all love the uncertain market going forward. And I hope the S&P comes down. Okay? If not, really that's the end of my presentation. Thank you very much. Okay? Maybe I'll just meet the 3 gentlemen over here. I'll pass you the book just now for those who answered the questions. Okay, if not, for the rest of you, you all can have the e-version because that one is a lot cheaper. Okay, so you just need to text your name and email to this number. Okay, the good staff from VIC will send you the e-copy of the book, including the book I co-authored with Value Investing College. Okay, you can find me at valueinvestingcollege.com. I also have a personal blog where I talk about some of my traits and why I do certain things on investingalways.com. Okay? If not, once again, thank you for your time. I wish you all the best in your investing journey. Thank you.